Welcome back. You're watching Halftime Report on CNBC-TV18. It's turning out to be a bit of a sluggish session now for the Nifty. So we're down around 0.4% currently for the Nifty. The Bank Nifty just about holding steady at this point in time. And the mid-caps, which have outperformed on a week-to-date basis, are still managing to hold their head above the water. But we have a lot of stocks in focus. Lupin, that stock is down around 4% after reporting their Q3 numbers late last night. Both the revenue and the margin were in line with estimates, and so were the US business, but the profit missed expectations, and largely there was an expectation that maybe it could outperform what the street was anticipating. I did catch up with Ramesh Swaminathan, who's the ED and CFO of the company, earlier this morning, and began by asking him about the contribution of key launches such as the bowel drug Suprep generic in the US and price pressure as well.
So as you would, know, first quarter results were, a bit of a surprise. It was about 125. Q2, we actually saw it rise to about $157 million. This quarter, it is $177 million, whilst the same time previous year was about 201. So obviously, it is there has been price erosion of a high kind. Essentially, you found price erosion in products like albuterol, Brovana, and famotidine. In the course of this quarter, we actually launched about 4 products. Altogether, all of the new products brought in about $20 million. So if you subtract 20 from the 177, we're talking about price erosion of a pretty high kind in the rest, so to speak. So that's where we are. Price erosion does continue in America.
To what extent does price erosion continue? Because a couple of quarters ago, it was so severe for Lupin that you had to exit some products. Is it as severe? Is there an improvement? What can you guide us on?
So essentially, if you look at the OSD business in America, it's been under pressure for quite some time. If you look at, in fact, what was a $65 billion opportunity 4 or 5 years ago, has now come down to about 56 in gross terms. In net terms, it's from 35 to about 30. OSD, in a general sense, is under tremendous pressure. That's essentially because the channel partners have kind of consolidated, and that actually has impacted a lot of the manufacturers. And that's the reason why I think the industry is going through some tough times out there. But there are silver linings. If you look at, in fact, the inhalation space, or for that matter, the injectable space, they're doing fairly well. And that's where the focus really is. We're kind of pivoting from, in fact, the OSD to potentially more complex ones, which includes the injectable space as well as the inhalations. And you know very well that inhalations we're pretty strong out there with the array of products that we are going to launch over time.
Okay. What is the run rate for the US markets on a quarterly basis then? At one point, you had guided for around $200 million as well. When do we see Lupin get back to those levels? Has 177 become a base?
As you know, we are focusing on, in fact, the more complex ones and getting out of products that where we believe the margins are going to be lower or are indeed already very low. It doesn't make sense for us to kind of continue. And that would actually mean that some parts of our portfolio might not necessarily be potent anymore, which is really the OSD bit. So I think the top line is really going to be a function of when we come out with, in fact, the relevant products of the market. I would imagine that the range for the next few quarters, until, in fact, the top line moves because of newer products, is going to be around the 170 mark, really.
Okay. Spiriva generic, the company as of last quarter had indicated that the queries have been responded to from the US FDA. You are working with the US FDA to get approval. Where do things stand?
So we have an early date with them. So we have been talking to them, and we are very, very hopeful. And anywhere between April and July is when we think that we would get the approval. So we are fairly confident that that launch would certainly happen in the next few quarters for sure, perhaps by September at very worst.
Okay. So have all the queries been answered, or has the US FDA come up with any fresh queries with regards to Spiriva generic from the last time you gave us an update?
No, there has been no new update and no new queries being asked. There is, in fact, early review being set by the authorities. And as I said, we still really are very hopeful that you would see a launch in the first half.
Okay. Well, margins have improved to over 12% for the company this quarter. Can you tell us what is your visibility for Q4?
No, as we had guided, we said that there would be progressive increase in terms of margins. That is actually coming in from, in fact, products that we bring to the market. And then you saw, in fact, that, I spoke about a cashier products that we brought to the markets in America. This quarter particularly, so you saw we were stymied a little by, in fact, the loss of exclusivity when it comes to India, so in certain products, for example, the Ondero, for example, there was price erosion because it went out of exclusivity. And that's the reason, for example, we had an impact insofar as the turnover for India itself is concerned. We also had a slight impact because of NLEM, the expanding list. But for sure, insofar as expenses are concerned, there is a lot of focus on that. We did speak about various initiatives that we are carrying on, which includes, for example, reduction of manpower at the factory level, R&D level, and the like, the footprint reduction. Looking at a host of initiatives on freight, on failure to supply, and other inefficiencies that there were in the system. A lot of it has actually been addressed. And you're actually seeing some parts of it, even in this current quarter. You would expect things to progress along good lines over the next several quarters. And as I said, we are looking at, in fact, a core EBITDA margin of between 18 to 20%, which hopefully we would be able to realize sometime during the next fiscal.
Tell us a little more about India, Mr. Swaminathan, because, in Q1, it was down 8.8%. In Q2, it was up around 2.6%. This quarter also, it's a single-digit growth, which is sub 5%. What is the pressure in the Indian market, and when do you expect it to pick up?
No, I think the way I see it is we continue to do pretty well in India. The reasons why it comes out as a lackluster performance is only because of the fact that there were a couple of products which went we suffered loss of exclusivity. The first was Sidbis. As you would recall, it was a product that was in license from Novartis, which unfortunately we were not able to retain, after it went out of exclusivity and it went on to a competitor. That, in any case, even if it had stayed in our stable, it would have actually, the prices have kind of come down dramatically. And equally with Ondero, this is a Boehringer Ingelheim on the respiratory, on the diabetes front. So that actually has also impacted dramatically. It's only the diabetes portfolio which is actually costing us some pain at this stage, but we're still growing in our class, really. So I think if you look at the next 3 to 4 years, we're fairly confident that you would see tremendous growth back, a secular about 10 to 12%. That actually would mean, of course, newer products and potentially looking at, more feet on the ground for of course, mindful of, in fact, the productivity concerns as well. And the confidence in the Indian market is still ripe for good growth for the next several years.
Mr. Swaminathan, leave us with some guidance.
Lupin's management, the stock in focus down 4% in today's trading session. We'll do one thing, slip into a short break now. On the other side, Sanjay Thapar, who's the ED and CEO of SJS Enterprises, will join us to discuss their Q3 numbers. So stay tuned for that.
Welcome back. Just keep an eye out on Havells. That stock's moved to the low point of trade. This morning, we got a downgrade coming in from CLSA on that counter. In fact, they believe that at 44 times FY25 price to earnings, they see valuations as unfavorable, and we are seeing the impact of that on the stock at the low point of trade. But let's talk about another company, SJS Enterprises. While they posted a strong set of third quarter numbers, the revenue for the company is up 21%, the margins up by 50 basis points year on year as well. There has been some sequential slowdown, and as a result of which we are seeing a decline in the stock price as well. Sanjay Thapar, who's the ED and CEO of the company, joins us now to detail those numbers, but more importantly, the outlook going forward. Sanjay, thank you for joining in. We've spoken in the past, and I was looking at the presentation that you've put out for your investors as well. Both of them are at a bit of a divergence. In the past, you've said that you target 25% revenue growth in this year with 30% profit growth. However, in the presentation, you've written you target 20% growth with 20 to 25% sort of profit growth. So should we consider that as a guidance cut, and which is why the street is a little disappointed?
So to answer that question, if you look at our 9-month numbers, so we have grown at 12%. and our EBITDA has grown by 30%. So we are bang on target. Essentially, the only thing that is impacting us, and that is why I'm open with the street to tell you that the export volumes, because of this ongoing war in Europe, so we're dependent on Europe and North American markets for our export business, and that is slowed down because of these macroeconomic challenges you have in terms of rising inflation, rising fuel costs. So those are the things that have not picked up in this fourth quarter, and that's why we are saying that our business is absolutely on target in terms of whatever we promised. But in the near term, we feel that revenue growth could be a little lower, and margins still will remain strong at 25% growth on PAT. So I think overall it's a good set of numbers.
Yeah, it is. Quarter 3 is good, but the thing is that since 9 months in 9 months, you have reported a 25% revenue growth and profit growth of 30%. So it looked like that you are scaling down your guidance, and that's the reason the stock is lower as well. You spoke about exports being a little weak this time around. In the first half, it saw 16% decline. What was the export performance in quarter 3, and what do you expect the year to end with? Because quarter 4, we are almost done with that as well. What kind of decline or what kind of numbers will the export markets report this time?
So let me put this in context. So for the half year that we declared results last time around, so we were growing at 26.5% YOY. The domestic demand more than supplemented the lack of export demand, primarily due to this war that's ongoing in Europe and the challenges you have in terms of sentiment, both in Europe and North America. So that we were hoping for a recovery, and that is why we stayed with our guidance. Now that we have seen Q3, we are still at 25% CAGR in terms of revenue growth and a 30% CAGR in terms of profit growth. But even quarter 4 is a little subdued. Therefore, we are saying that the numbers are slightly down. So structurally, there's nothing wrong with the business. We've not lost any business, any customer. So it's just a situation about external factors playing in. So we are in absolute transparency saying that we could still hope for a 20-25% growth in PAT. So that's what we've guided the market.
Okay.
It's not at such a variance. Sorry, it's not at such a variance from the original guidance that we have. So we've consistently delivered this 25% growth that we've been talking about. And over the medium term, we still remain bullish on this 25% growth and 30% growth in profit. That's what we are guiding the market still at.
Okay. Mr. Thapar, in fact, I think you've added 2 clients in this quarter. Foxconn in your EV segment, and within your consumer durable segment, you've added IFB Industries as well. Can you just tell us how much do you think you're going to make from these 2 particular orders? What are they worth? Is it a continuation of an earlier order that you already had? Are they fresh customers?
No, so these are fresh customers, and they are very large customers. So Foxconn, as you may know, is one of the largest assemblers of electronic components. Earlier on your show, I guided that, when localization of these display screens in India comes, so we are actively working on that area. So we won business from Foxconn for a EV display. So we supply a part which is a cover lens, and this is a new business. The potential is immense. So this is just starting this whole business. And in the future, I think all EVs...
When you say potential is immense, Mr. Thapar, just give us a number. How much do you think you can probably make in FY24 based on visibility, the quantum of these 2 order wins?
The first business is almost about 5 crores in terms of revenues, but as I said, any new product takes time to get to the market, and what is deployed across other models. So this is starting of that traction. So that's more significant from that perspective, that this opens the doors to a very fruitful relationship, and we think this volume will increase further. So it depends, the guidance in terms of what numbers will come by, I would not like to quote that specifically. But there's a lot of opportunity where all these vehicles will require products like this. So moving forward...
just before we let you go, wanted to know, the last time you joined us, you said you're in advanced negotiations for an acquisition. Where has that gone right now, and when can we hear about it?
So I will make that announcement once we close the deal. So it is still work in process. So I would not like to guide you at this moment. But be sure that as soon as we conclude, we will come out with an announcement.
All right, Mr. Thapar, so we'll have a conversation on that day, but thank you so much for joining us and making sense of Q3 numbers, the demand trends as well, and the outlook going forward. That's the word coming in from SJS Enterprises. The stock is lower by 6.5% in trade today. Time for a break now. On the other side, we'll speak to the management of Rainbow Children's Hospital on their quarterly performance. Stay tuned.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, it is turning out to be a day of consolidation. So let's get talking to a couple of companies since it is the end of earnings season. We have a lot of broader market companies which have released their numbers. One such company is the hospital company Rainbow Children's Medicare, which posted a strong set of Q3 FY23 numbers. Revenue and EBITDA has gained this quarter. We have with us Dr. Ramesh Kancharla, who's the chairman and the MD of Rainbow Children's Medicare. Remember, it is a pediatric hospital. It has a bed capacity of over 1,500 beds totally. Dr. Kancharla, thank you very much for joining in. Well, you know, I wanted to start by talking about the occupancies. If you look at the occupancies on a consolidated level, they've dipped on a sequential basis. I'm assuming that's because of seasonality. But can you just tell us, you know, the key highlights in this quarter gone by, and where do you expect occupancies to probably sustain at?
Yeah, that's right, Ekta. I think there's a slight dip in the occupancy sequential basis. That's because of the, you know, in the Q2, we had a, you know, the horrendous, viral season. That's led to the lots of children getting admitted for the shorter duration. If you look at overall on the top lines, it's not much of reflection there. So the quality of business is increased, and though there's a slight dip in the occupancy.
Okay. So what kind of occupancy levels are you targeting in this year, Dr. Kancharla? And about average revenue per occupied bed as well. It has increased despite occupancies falling. What is the sustainable number here? Will it see a further increase from the 48,000 rupee level that we are seeing right now?
The earlier what we have guided is about 48,000. I think we're absolutely bang on that, whatever we have guided. So moving forward, I think it will stay on the same for the year. I think year on year, what we were actually earlier guided is about the 4 to 5% increase on year EBITDA increase, the ARPOB increase. So I think the quality of the business, which has actually made us to have a better ARPOB in the current quarter.
Right. Dr. Ramesh, I just wanted to understand what's the divergence in terms of operational performance and average revenue per occupied bed for your mature hospitals and your new hospitals, and by when do they come together? When do they converge?
Yeah, I mean, I don't think they would come together anytime, because as we go on, we keep adding the beds every year. When our run rate of adding beds about 200 beds from now on. So there's going to be always a gap, because matured beds, with what we say is over and above 5 years time. So they keep tracking positively on the going uptrend in the occupancies. However, when you look at the new emerging beds, which are maturing beds, they also keep tracking. So in a pediatric business, what we see is that now it's very organic business. We don't have much of government business. We don't get through the sales and marketing too much. It's a very organic business. So therefore, it's very dominantly a kind of insurance based. We deal with young parents. So 30% of the occupancy is usually 30 to 31. It gives us a kind of a operational break even, which is why we always try to see that our operational break even in existing cities where we do our spokes, we expect it to be around turn around 18 months time. So, and when you go into the new places with the hub hospitals, obviously it takes much longer time. So there's always going to be a kind of a gap between the mature and maturing hospital, because as long as we keep adding the beds.
Okay, just a quick last question then, Dr. Kancharla. The surgical mix, that's because your average revenue per occupied bed has improved despite your occupancies dipping. So I'm assuming that your surgical mix is probably getting more complex as well. Can you just tell us where it stands for complex surgeries versus more routine surgeries? And where do you expect that share to probably move?
We have three parts of business in pediatric domain. And one is that, dominantly the intensive cares and the super specialties business. That's about 40%. Pediatrics is dominantly a medical specialty. The surgical business will be less than 10% overall. So when we look at the intensive care services, both neonates and pediatric intensive care services, plus super specialties constitutes about 40% of the business. And we have our obstetrics, which is about 30% of the business. So the rest of it is all kind of a general pediatrics and specialties, surgeries, various other things comes into the 30% of the pie.
Okay. All right, Dr. Kancharla, it was a pleasure speaking with you. Thank you so much for joining us today and detailing Q3 numbers and the outlook going forward as well. That's the word coming in from the company. Rainbow Medical, the stock is up 1.5% in trade right now. With that, we'll slip into a break and get you more on the markets and stock-specific action on the other side. Stay tuned.
Well, those are M&M's numbers for you on your screen, and it looks like an extremely strong set, notwithstanding the decline that we've seen in the net profit as against the street's expectations, and that's because of an exceptional loss of 629 crores. If you adjust for that, the revenue and the operating performance of the company is extremely strong. In fact, the revenues of the company have grown by 41%. CNBC-TV18 was expecting a 40% jump. 21,389 was the poll on the top line. The company has reported 21,654 odd crores. Even the EBITDA, in fact, the EBITDA of M&M this time around has come in above 2,800 crores. The street was expecting a number of 2,730 odd crores, as a result of which margins have come in closer to 13%, 12.9% versus expectations of 12.7%. So on the top line, there is a beat. The EBITDA and margins, there is a mild beat, but the net profit is impacted by a 629 crore exceptional, which is why it looks optically lower than the street expectations. And as we speak, the stock too, after that initial dip on the net profit, has recovered from the lows and currently moved into the green. A strong set was expected. A strong set is what the company has delivered. The only thing we need to know is how much of that is already in the price because of the strong outperformance that we've seen on M&M itself, mildly higher.
Yes, absolutely. That's exactly the point. The stock has rallied over 80% from its March 2022 lows. So a lot of this good news is probably already factored in. Yes, the revenue has largely come in line with estimates. It's just a mild beat on the revenue front. The margin should show up for you, but like Mangla mentioned, there is an exceptional which has pulled down the profitability. Just want to point out that remember that in any case, we were expecting a very strong quarter simply because of the auto and the farm equipment business. In fact, the auto and the farm equipment business achieved their highest ever Q3 volumes. The company has indicated that they are number one in the SUV revenue market share in Q3 of FY23, which stood at around 20.6%, and the market share in the farm business stood at around 41%. So those kind of measurables were already factored in for the street to indicate that this is going to be a strong quarter. In fact, we do have Sonia joining in to tell us more about the numbers. Sonia, it seems as though there's a bit of a profit miss.
There's a profit miss, but I think on the margin front, it's a pretty good set of numbers. So for 3 consecutive quarters, M&M was hovering anywhere between about 11 to 11.5% margins. This quarter's margin number at 13% just goes to show that, they have sort of improved their operational performance quite a bit. And, as you were also mentioning, the stock has seen a huge run-up already. Despite that, there is a follow-on buying because the operational performance is good for 2 reasons. One, of course, raw material prices have fallen. The other thing is that now they have a better product mix. So they're selling higher number of high margin tractors, and that indicates that perhaps the realizations for the company have also gone up. Now, if you look at it, the agri business EBIT margins are at about 16.6%. They did about 16.4% last quarter. So in that context, the agri business, which is a tractor segment, has been growing well. Remember that the rural market is now starting to recover a bit. So this is it's a good indication that the agri business is on a improving trajectory, which the street may definitely like. Even in the auto segment, they are selling more number of SUVs. And if you look at it, the EBIT margin at 6.7% compares to 3.5% year on year. So they've doubled their auto segment margins on a year-on-year basis, which is very, very positive. On most fronts, I think the operational performance for M&M is looking pretty good. And also, as they launch more SUVs and even the electric vehicles, their margin performance, their blended margins are expected to improve quite a bit. In fact, most brokerages believe that the margins could be in this range of around 13 to 15% for FY24. So these are a good set of numbers, but perhaps a lot of the good news is already in the price, considering the stock has rallied so much, it's outperformed the auto index as well. No problems with the numbers, but yes, the profits are slightly below what the street was expecting because of that exceptional. Back to you.
Okay.
Okay, I think Ashwin Patil is with us. He tracks M&M very closely. Ashwin, thanks for joining in. Just a quick word, EBITDA at 2,800 crores and margins at 13%. I think, after 3-4 quarters of 11.5% margins, now Mahindra & Mahindra has moved to 13%. Do you like these numbers? And what about the stock? Is the risk reward favorable at this price?
See, the auto pack already has, this is the last company within the auto pack to come out with the results, and everybody is seeing a very superb kind of margin performance, basically because of the RM cost, the input cost reduction, and the product, the mix that the company, specifically talking about Mahindra, the mix that the company has, been the launch of the products that it has come out with, the mix has improved a lot, and also the pricing has improved, and the farm equipment segment has performed well. So overall, overall, it is firing on all the cylinders, I would say. And that has resulted into this kind of a performance. And definitely, like PAT, as we all know, that it is down because of the exceptional item. But considering the price at which the company is right now, 1370 rupees, I think, everybody may be saying that it is in the price, but still I think that, with the chip shortage out of the way almost, and the company being able to cater to the volumes and all, we can see a good volume performance as well as margin performance going forward. Definitely there is some steam left in the stock, I would say. And in FY24, maybe the farm equipment segment may not perform up to that extent, but because of the high base of FY23. But on the auto segment, the company is expected to do well with the new launches and all. So I think that there is some steam left at least, and we are going out with our buy rating as we have been always there.
Okay, so there's some steam left. And, even if you compare the results with its peer Escorts, right? Escort reported very weak set of numbers, and they said that it is the inflation situation, the delayed price hikes, which have hit their numbers this time. In comparison, M&M's margins have been quite steady in the tractor business. The EBITDA has improved as well. Their market share in the agri business is 41% now. They've gained a bit of market share. So don't you think if you compare, of course, M&M has the auto side as well, Ashwin, but is M&M sort of gaining more ground compared to its peers like Escorts? And what kind of premium would you give the stock now? You said that you're expecting a further upside, but what would your target price be? Would you raise your EPS estimates or earnings targets post these numbers?
It being the market leader in the FES segment with close to about 41-42% market share, and it is gaining because it is entering into some certain geographies where it is not that strong. But the company, the other companies like Escorts, etc., we are seeing some impact of inflation, and but Mahindra has been performing well because it is, we all know how strong it is everywhere. And overall, I think the Rabi crop has been, the output has been very good and all. I think the company is well set, and also they have come up with certain launches in the smaller segment as well. The higher segment, the higher HP segment is already there on a strong wicket. So I think that the company is well poised for a good, growth going forward. Though the farm industry may not perform that great because already it has performed well over the last 2 to 3 years. But still, this particular company, I would say that it is in a, on a stronger wicket than others. And talking about the target price, etc., we were having a target close to about 1,500. But now I think, with the numbers, we will obviously roll over to FY25 numbers and close to 1550 or somewhere. I mean, I am not sure. I have to work on the numbers. After that only I'll be able to give you a clear picture on
thanks a lot for joining in. So in case you've joined in late, the M&M results are out and the numbers are looking pretty good on the operational front. It's a good improvement that M&M has seen revenue growth in excess of 40%. Margins have improved to 13% versus 11.7% same time last year. The auto business is doing very well. The margins have doubled there on a year-on-year basis. Of course, over there, it's a combination of lower raw material costs as well as price hikes along with a better operating leverage for M&M, and that has resulted in both auto and the tractor business doing well. The agri segment market share has risen to 41%, so it's a market, continues to be a market leader there. The profitability, you can of course complain that there is an exceptional because of which the profits were slightly lower than street estimates, but all in all, these are a good set of numbers. The stock perhaps has already seen a lot of it in the price because it's rallied substantially, but good numbers and strong operational performance from M&M. Back to you.
All right, Sonia, thanks a lot for that. So that's about M&M. With that, we're out of time on this edition of Halftime Report. You stay tuned to CNBC TV18. Business Lunch comes up next.